I think that we can all agree that the past 2 years have been chaotic, just to say the least. From a real estate perspective, watching the price rises, the inflation, the interest rate hikes, the supply chain issue, and navigating all of this has affected us all in one way or another. But there's two main factors that people are talking about quite a bit right now, which are inflation and interest rate. People want to know how they're gonna get affected by this, so I thought I would do a video about those very things based in facts, how we're gonna get affected locally, and also I'll give you my opinion about where I see those things going in the near future. There's also another major problem that we're facing right now that most people don't know about, and if you stick till the end, I'll tell you what it is. For our new viewers, I release a new video weekly about all things Ottawa, so make sure you subscribe and like the video. Let's start this with something very exciting. What is inflation exactly? Very basically, it's attached to the cost of goods in your life, like gas, rent, electricity, grocery, etc. When inflation goes up, it means that your money doesn't go as far as it used to. Inflation can happen for many reasons, like increase in production costs, like raw materials and wages, but it's most likely due to the government printing more money. When you inject more money in the economy, each individual dollar worth less, and that makes the price go up. By printing that much money, we kept the interest rate artificially low, but that created a situation of hyperinflation in real estate. The government did so to stimulate the economy during COVID, but now that the economy is being overextended, the government is looking for ways to slow down the inflation runaway, and the simple solution is raising interest rates. So we are closing on 6.8% inflation, which is the highest rate we've seen since 1991. Naturally, the Bank of Canada is doing what we need them to do, which is protect the economy, and to do so, they increased the trend-setting rate by 0.5% for the second month in a row, putting the rate at 1.5%. The Bank of Canada made it very clear that they will do whatever is necessary to bring the inflation back to a normal level between 1 and 3%. Coming from the Bank of Canada, this is a pretty aggressive and bold statement, and a lot of people are taking notice of this. Senior Wealth Advisor at Meridian, Jordan Damiani, said, the Bank of Canada said that they were ready to act more forcefully. So that was one thing that would potentially suggest the pace of rate hikes could still be even more aggressive than it's projected. To be clear, no one is surprised that the rates are going up. Everyone could have predicted this, but what's surprising is how aggressive Bank of Canada is. Bank of America Securities economist Carlos Capistran wrote that we believe that the Bank of Canada clearly wants to move fast to the 2 to 3% neutral range. So a 75 basis point hike in July is a very real possibility in our view. 75 basis point means 0.75% on the basic rate, which would put the basic rate at 2.25%. I mean, just the fact that this is considered a real possibility tells you a lot about the states of the economy and the mind of economists right now. So is this sign of a real estate market crash? Media will jump on it and tell you yes, because it gets more click, but reality is we're just going back to our normal market, right? Before COVID, before this frenzy, we would see 3 to 6% increase annually. To see 20 to 25% year over year is unsustainable and it's undesirable. Realistically, what are those numbers actually mean for you? Well, there's two categories of people that are gonna get affected by this the most, right? First-time home buyers are seeing their borrowing power diminish, every time there's a rate hike, so that hurts. The second are the people that bought at the peak of the market. If they took a fixed rate mortgage at this point, it's not going to be a problem because a fixed rate mortgage, actually the bank guarantees you that you're gonna have the same payment. Those with a variable rate mortgage though, they're gonna feel the heat immediately. For the average Canadian house, they could pay as much as $1,000 extra compared to what they would pay generally. If it's your case, don't panic, but I suggest that you give a quick call to your mortgage specialist. I wanna hear it from you guys. How did you get affected by all of this in those crazy times? Just put down a comment below. For the rest of us, it just means that we're going back to a balanced market. And don't get me wrong, it is still a solid seller's market. Even though a lot of listings were being postponed or canceled after the big storm that we had in Ottawa, but in May overall, the inventory increased by 18%. Condo inventory, however, is down 0.4%, and that's just because it's now the point of entry for a lot of first-time home buyers. Like I said, the borrowing power gets lower, condos are more affordable, so everybody jumps on condos, so there's less inventory on that side. Prices went down 2% in May and 2 to 3% in April, but don't panic because since January, it was 2 to 12% increase up until April, right? So we're still in the positive. Also, days on the market went from 11 to 14, and it's not anything close to the 30 to 60 that we usually see in the balanced market. It's saying that the market is slowing down a little bit. So after all of this, I'm not telling you should buy, you should not buy, you can decide this on your own, or you can call me, we can talk more about it. What I'm saying is, do not buy into that media frenzy nonsense. There's a few numbers that you should keep track of that are gonna be a much better reflection of the market than big headlines. So the first number you wanna keep track of is inflation rate, right? Realistically, we want this number to go down to a normal 1 to 3%. A high inflation rate means that everything you buy is gonna be more expensive, your money worth less, so everything's more expensive. When inflation reaches a healthy level, then interest rates will go down to stimulate the economy back again. So that's what we should aim for. Hopefully the government would have learned from their mistake and not do the same shit over again in a few years, but very unlikely. Number 2, interest rates. The average interest rates were 4 to 6% over the past 22 years, and that's what we should expect moving forward. In the midst of all this, I still hope that the government would put measures in place to combat, housing crisis that we're seeing right now, the unaffordability of properties. I'm working on a video right now about Ford's platform, and it's very unlikely to make any major impact. And for those of you who are a little worried about the interest rates going up, just remember that in 81, we had inflation of 12.7%, and interest rates peak at 21% to fight this inflation. So for now, we're good. The last number that you should keep track of is home appreciation. Normally, we should see 3 to 6% home appreciation year over year in Ottawa, according to the past 30 years. I do think that in Ottawa, our average annual increase moving forward might be higher than this simply because Ottawa has become so popular with newcomers, with investors, and with people looking for a family-oriented city to sell in. When you compare the average 3 to 6% to the 45% that we've seen in the past few years, you can easily tell that was unhealthy at best. All of this being said, people are still selling properties, people are still buying properties, and we are nowhere near a crash. The only thing is that sellers now have to put a little more thought into their listing strategy, their marketing plan, and make an actual effort to make their house stand out. And oh, surprise, this is kind of my job. So guys, don't hesitate to call me, or you can also go in the description and you have a link to book an appointment either on Zoom or in person if you prefer. I told you guys about the third problem. Interest rates and inflation are part of every real estate talk these days, but another problem lies with investors. When you hear that Blackstone, which manages $1 trillion in asset, opens an office in Toronto, that can't be good news. I cover this very topic in the next video over. But if you guys have enough serious stuff for one day, you can kick back and look at the 5 most expensive sales of 2021 in Ottawa. I'll see you in the next video, guys. Have a good one.